Hello, everyone, and thank you for joining. I'm Kristen Hull, and I'm excited to be welcoming you again. And we'll be joined by various team members today from the Nia team. And so this is our portfolio team, Jethro Townsend, Samporna Kasnavis, and Christian Revels-Robinson. And we'll also be joined by both Holly and Nicole, who will be sharing some of the insights from our impact report and some of the metrics, and then a little bit behind the scenes about why we are measuring what we're measuring and why we're reporting out on some of the metrics that we're reporting out on. And so I believe most of you know, though, if you are new to Nia, the word actually comes to us from the Swahili. It means intention and purpose. And we are using the Nia principles for both investment, for looking for companies that are created and bound by intention and purpose. And then we're also building our team that way. And so our investment thesis is to invest for the world that we want to see, one that is both sustainable and inclusive for people and planet. And so you'll see as we talk about the market trends, how we are viewing that from the lens of investing for the world that we want to see. We're also looking to literally capitalize on the transition from the incumbent economy to a just sustainable and inclusive economy. And so thank you for being with us for this. I'll just jump forward with some of the trends. I'm also going to be passing over to my colleague Christian, who will go into more of the specifics on what we're seeing in the markets. And then in these volatile times, what does it mean to have a government shutdown? What does it mean to have volatile tariff policies? And how is that playing out both in the markets and then also for our own investment thesis? I think you all know this, and it doesn't hurt to reiterate that every dollar we spend and every dollar we invest really does count as a vote for the economy that we want to see, and where you invest matters. And so making those choices and making really conscious choices about investing for the economy that really is going to work for everybody. So we really appreciate your time and attention with us today. As we're looking at just kind of a prelude for Christian, who's going to share some of the economic data that we're seeing, the backdrop isn't new to anyone, and yet how is it playing out? So what does it mean to have the longest government shutdown that anyone has ever seen? It's certainly unprecedented. And of course, the reasons and the fights and the disagreements over a really core human rights issue and one that's core to the economy is healthcare. And so can our leaders get together and actually approve a healthcare plan? It's questionable. It's really questionable. And what does that mean then for the economy? And where do we need to be more defensive? What are the sectors and the well-run companies that are going to both benefit from these types of volatile issues? And then what are the ones where we need to be a little bit more cautious? I would say one, just the theme of the year continues to be volatility. And a lot of that is coming from the erratic tariff policies. And something to note there is not only is it affecting, the news and the headlines here, it's also affecting what's happening abroad. And so as we, some days have tariffs in Canada or China, and then they shift, these countries, all countries are really reevaluating where is it best to do business? What can they manufacture at home? Where can they shore up and bring local? And that we've just seen headlines about China having their chips come from China, largely based on how they feel that they're being treated by the US as far as fair policies. And so what will that mean for our chip makers here? What will it mean for the global economy? Because as we know at NIA, it's not just the tech sector. Every sector of the economy really is tech enabled now, and we'll get into how it is also being affected by and also benefiting or being constrained by the use of AI. And so what does it mean for our trade and our tariffs what does it mean for our trade partners when tariffs are volatile and when they're not predictable? And when other countries don't feel that they're being treated fairly, they are reorganizing. And so literally our trade routes are getting reorganized and global relationships are getting rewoven. And so we're going to be seeing different powers coming to rise. And of course, we know from history that those countries that focus on power sources are the ones that really prevail in the global economy. And we saw this, and we spoke about this a little bit in our last webinar about how England and the UK in general really capitalized literally on coal and on fossil fuels, and they really came to rise. Then it was the US who harnessed oil specifically and became a global leader, both in trade and then also in production and refinement. The next wave is renewables. And who is going to have the corner of the market? Well, it looks like the US is choosing not to lead in that area, not strategic if we look at history as far as who's going to be an economic and global leader. And so we are seeing China rising both in production and innovation, and then also really just putting dollars. And so where can we as investors be looking for these trends and then be seeing what are the most sustainable and the most well-run companies that we can be investing in? I think one more thing I'll add just before heading over to Christian for additional insights is as our relationships get rewoven, our global relationships as far as trade, it's really going to see which country does it best, who can produce whatever is needed best, and then transportation. Can we be looking at that with a sustainability mind? Are we well, this actually comes in with the airlines because in the US, with the government shutdown, we have fewer airlines flying. And so, what does that mean as far as being able to get people as well as goods and services to where they need to go? So, we're definitely seeing a shakeup and some opportunities and then some constraints there. And then, just another global trend that really is emanating from the US, though we're seeing it across economies, is the pushback against DEI, diversity, equity, inclusion, and largely we're looking at human capital management when we talk about these issues. With the current government pushback, that doesn't mean that it's not a best practice for companies. And so that's a place where both we can have impact as investors, we can raise our voice, and we can really double down on checking in with companies about, are they remaining in their best practices? Are they continuing to be able to recruit, to hire, and to promote really the top talent? Because what we want to see in all of our companies is that they are able to retain top talent. And the research does show that diverse and loyal employees equates to significant ROI, so return on investment. And so we're looking to have our most well-run, efficiently run companies that are paying attention to what others might be considering not material, we're considering quite material. So with that, I'm going to hand it over to Christian. And as she's prepared her notes, of course, you can imagine with the government shutdown, we've gone back and forth on what is relevant and what's actually timely this morning. So over to you, Christian.
Thank you, Kristen. Hi, everyone. I'm Christian, and I am an equity analyst covering consumer and utility names. So I wanted to take the time to double click on the government shutdown and what that means for us and how we're thinking about it. I think the biggest thing that we wanted to highlight was just critical economic data from the Bureau of Labor Statistics, the Bureau of Economic Analysis, and the Census Bureau has been suspended, halting the release of monthly job reports, CPI, retail sales figures, and housing market data. This unprecedented information vacuum makes macro analysis more challenging. So we're still able to do our work, but there is a large segment of information that we're used to normally incorporating in our analysis that we do not have access to. So think of it as a data blackout right now. So Nia has been fossil fuel free since inception, and we're also fossil fuel adjacent free, which makes us insulated from the 1,500 plus flights that were canceled Saturday, with 30% of flights delayed, as the FAA enforces mandatory capacity reductions at 40 major airports, starting at 4% on this past Friday and escalating to 10%, presumably by November 14th. So our positioning has helped us in this way. We're seeing massive disruptions, as Kristen noted before, amongst the airlines. And that looks like reduction in flights, cancellations, everything across the board, which has ultimately led to large amounts of consumer frustration. To go to the next point, approximately 900,000 federal employees were furloughed, and roughly 1.5 million federal employees are missing paychecks, likely leading many to cut spending despite guaranteed back pay. So I'm the consumer analyst. I'm constantly thinking about how consumers are spending, where discretionary spend is, what is essential for them. And as you might presume, once individuals are not able to get their as promised paychecks, like that spend usually dials back. Another point there is that SNAP, or the Federal Government Assistance Supplemental Nutrition Assistance Program, accounts for 124 billion annually across 262,000 U.S. retailers, with approximately 8 billion monthly at stake during the shutdown. So people who are on the government assistance in terms of SNAP benefits are not receiving this money, as the budget has come to the budget basically ran out during the shutdown, and they were not able to allocate new funds. And nearly 42 million Americans, or 1 in 8, rely on these benefits, which is creating material demand destruction in the grocery channel. So Walmart, despite ostensibly offering lower prices, has been found to be very extractive in communities, and this is coming from practices of low pay and difficult work environments for employees. This one retailer accounts for around 24% of all SNAP shopper spending, which is triple Kroger's share and significantly ahead of Costco, Amazon, and Sam's Club. Luckily, we are not in retailers like Walmart, so we are not seeing the bulk of the SNAP disbursements and the revenue profiles that we look at. And I think we're strategically positioned in that way. But again, this will trickle down to shopper spend in names like Costco and even regional grocery retailers or smaller retailers in which we are currently invested in. So larger chains are more apt to absorb these SNAP cuts, but small independent grocers depend on SNAP maybe a bit more than the Walmarts or the Costco's of the world. So we're thinking about this in the sense that there could be more of cuts or more compression in consumer spend for this quarter, given those SNAP benefits did not flow through for such a significant point of time, the Center for American Progress identified around 27,000 retailers, mostly in rural areas with large SNAP populations, as most vulnerable to the cuts. In terms of updates from today, House lawmakers returned to vote on ending the 43-day shutdown, as it has already passed Senate. So we are diligently and eagerly waiting to see what happens. But this has been something that's impacted various parts of the markets and has been something that has left us in a bit of an economic data blackout. So we're very hopeful about what's to come. And as you all are, I'm assuming we're staying tuned to see if or when the government shutdown will end. So I'll pass it on over, but that was all from me.
Thank you, Christian.
Yeah, thanks, Christian. I'll take it from here. As one might imagine, we've been fueling a lot of questions about, as Christian was talking to you at the beginning of the conversation, around what's happening with AI and the question of whether or not we're in a bubble. We thought it'd be instructive to at least, try to sort of graphically illustrate and quantify, what that means in terms of valuation. So if you look at this first chart on the far left, it just shows the forward PE, price to earnings multiple, of the tech sector during the dot-com bubble, which is in green, relative to where we are today on a forward PE basis, where we can see that, the markets, while they're not cheap on a price to earnings multiple, they're also not as expensive as during the dot-com bubble. One of the things that it illustrates is that, the companies today now have significantly more earnings power than like the dot-com companies, which many of them didn't have revenues. A lot of them just were going to be printing red ink as far as the eyes can see. So that's sort of one big difference that we see today versus the dot-com bubble. And if you look at this middle chart, it looks at the overall market. So it looks at the overall market cap of the market to the country's GDP, and you can see from this perspective, we are more highly valued. Like those earnings are more highly valued today than they were during the dot-com bubble. One of the things that just sort of alludes to is the fact that we're seeing a valuation premium that's starting to sort of move outside of just the technology sector, where other companies that are sort of AI adjacent are also starting to be more richly valued. And the chart to the right just shows one of the other risks. So while we don't have the same level of relative valuation risk as a dot-com bubble, we are starting to see concentration risk. So the top 10 tech companies, for example, are now around 40% of the overall market, which is a higher level than what we've seen even during the dot-com era. If we go to the next slide, we drill down further on just looking specifically at the technology sector, like the top 10 technology stocks more specifically. The previous chart showed absolute valuation metrics. This gives us an indication of, from a relative standpoint, how expensive are these companies relative to the market versus the dot-com era. And you can see even on this basis, the top 10 tech companies aren't trading at as much of a premium as they were during the dot-com era. Now we know that technology stocks usually trade at a premium relative to the market, and so what's not shown here is that on average, technology stocks tend to trade at about a 20 to 25% premium to the market. Now that's closer to about 30%. So while we aren't at those dot-com extremes, the markets aren't cheap, by any measure, and that's something that bears watching and something that we continue to kind of look at Nia. If we go to the last chart here on AI, so looking beyond just the equity prices and stock prices and equity premiums, we think it's instructive to also focus on what's happening with the balance sheet and the levels of spending that's happening in the sector. So you can see here with this chart, the level of spending for 2024 was around $200+ billion in capex. That number is ballooning to around 500 billion for around 450 billion for this year, and that number is expected to ramp up over the next several years to 500+, 600+ billion over the next couple of years. So the debt is something that we should really start to think about as these companies deploy capex. I think that for now, the cash flows from these large mega cap companies are covering about 70% of that capex. The other 30% is likely to come from the debt markets. Increasingly, we're seeing asset-backed deals that are being done to cover some of this capex, in addition to the private credit markets. But the numbers, are quite sort of mind-boggling. But for example, I was reading this morning, like the leading AI company is expected to, the capex needs are about 1.4 trillion over the next 8 years. And this is versus, a company that has $20 billion in annual revenues today. In addition to that, they're also expected to be in losses, by $70 billion in losses in 2028. That company in particular saying that they expect to be profitable in 2 years later in 2030. But as one can imagine, it's hard to sort of see where the revenues and the return and the ROIs or returns on an investment are going to be sufficient enough to justify this capex. So that's another area where we see potential risk in this equation. So it's something that we continue to kind of monitor. And I think that when you're looking at the overall level of debt, we'll continue to monitor sort of the credit default swaps market to see where there might be some potential risk of downgrades in some of these stocks. And on that, I'll pass it to my colleague to provide further thoughts on the energy transition part of this equation.
Thank you so much, Jethro. So I'd like to follow up on Jethro's slides by talking a little bit about what a significant portion of this capex is being spent on, which is on data centers. In previous webinars, we've talked at great length about the surging power needs of data centers and the consequent electricity shortage. And I want to illustrate and reiterate this challenge with a couple of data points. The first is that a typical AI data center consumes as much electricity as 100,000 households. And another point that was mentioned by one of our holdings companies in their recent earnings call was that if you look at the numbers before the advent of generative AI, The power consumed by a typical server rack in a data center was in the 10 to 15 kilowatt range. Right now, one of the chips that's used pretty widely is the GB200 or Grace Blackwell 200 chips from NVIDIA, which consumes 120 kilowatts per rack. And in the next 2 years, with the next generation chips that are coming out, the Rubin chip is expected to consume 600 kilowatts per rack. So that's an increase from 10 to 15 kilowatts per rack to 600 kilowatts per rack, which is a really sharp increase in power. Currently, renewables supply about 27% of this power that is used in data centers, second to coal, which supplies 30%. And this renewables number is set to grow pretty significantly, as is shown on this chart, in the next few years. The two significant advantages that renewables have over traditional oil and gas is that number one, it's cheaper. Number two, it has shorter lead times, which means it's much faster to set up the plants and get them up and running. The annual average rate of growth for renewables capacity generation is 22% compared to natural gas powered electricity generation, which is 4%, and coal, which is actually set to decline over the next year. Moreover, renewables plants typically take 1 to 3 years to set up. Of course, this depends on a wide variety of factors such as geography, permitting costs, regulations, etc., compared to traditional oil and gas, which takes up to 5 years to set up. So the summary of all of this is that we need a lot of power and we need it fast, and renewables are positioned the best to be able to address this challenge. When you place these facts next to the electricity shortage that we're currently experiencing and the rising electricity prices that are being experienced by regular customers like you and me, renewable energy and battery storage presents an incredibly valuable and attractive proposition for investors. And this has been reflected on the next slide in the stock prices for these companies. So as you can see in this chart, the S&P Global Clean Energy Index has outperformed the S&P 500, the MSCI World Index, which is a global index, as well as the NASDAQ 100 in this entire year since January. The Nia portfolios, of course, have always focused on clean energy as one of our prominent solution themes, and we have been very well positioned to take advantage of these tailwinds in this energy transition. With that, I will hand it over to Kristen.
Thank you, Sampurna, so much. So as Sampurna mentioned, we are, definitely here to harness what is happening in the changes in the economy and seeing that sustainability wise, as well as market share wise, renewable energy really does have the opportunity. Of course, we would like to see more investment from the US, and yet we are seeing that across the globe. So following that and also looking to be best positioned in those companies that are growing, particularly in the publicly traded sector. And you can see that Sustainable Planet is one of our 6 solution themes. Within that, we're looking at energy sources, of course, and then also what is the infrastructure surrounding that. And so we're looking at energy efficient buildings, what are efficient, what are supplies, and then across over to healthcare, specifically focusing on women and people of color that can often be overlooked when it comes to research. Where can we be best invested in the healthcare sector, which interestingly during these times can be a little bit defensive and well positioned for the volatility that we're seeing. Over to natural and organic foods, a large part of our investment thesis is having impact by placing investment with companies that are doing good for the planet and that are actually having their revenue sources come from one or more of our 6 solution themes. So when it comes to natural and organic foods, we're looking really at healthy people and healthy soils. And what are the companies that are really prioritizing those getting sustainable solutions to market? And then affordable transportation. We're not actually as interested in individual automobiles as we are in public transportation, and yet the investable places where we can look can include trains, can include metro, can include, we're doing research on electric buses. We haven't found anything that fits our thesis there, though we continue to look, knowing that getting people, goods, commodities to where they need to go is a really important driver of the economy. Just over to eco and affordable housing. In a similar way, we're not looking to see housing be privatized. And yet, where are the places that investors can look out for making homes more affordable and then making them more ecological and sustainable, and in particular community driven where we can see that. And then thriving communities, where they're looking at communications. There's different ways where we're looking at education there, and what are really the infrastructure, the technologies that support our communities to be strong. And where can we find investment areas there? So I share our 6 solution themes because that is a large part of what drives our impact. And as we share more and move on to share what's in our impact report, there's a lot of different levels that we're having as far as our impact. So one is literally getting the economy that we invest into. When all of investors or any investors drive their money towards the solutions, then that's what's going to grow. And so that's one way that we're having impact. And then as you'll see, as our colleagues at Nia share more about what's inside this, we're actually asking companies for information. We are talking to companies about what matters. We're raising our voice with companies. And then we are monitoring and measuring some of their commitments, both on the carbon side, on the environmental side. How are even our very best players, as far as the companies we deem to be the best to fit into this portfolio, how can they also become even better players? And so monitoring that progress across companies. So we are looking at our engagement activity, and this is a goal that we have to reach out to and be in communication with every one of our companies, and in particular about the areas that matter. And so looking back, where did we do the most engagements? And so we're looking at community, equity and access, climate solutions, as well as sustainable futures, and then also corporate accountability and transparency. And so some of that is about CEO pay, some of that is about human capital management, and beyond.
Thank you, Kristen. And so across those 3 engagement categories, Nia had a total of 220 engagements during the time period of our firm impact report. This included written engagements, public statements, annual general meetings attended, and holding events and presentations with different portfolio companies. For one example of an annual general meeting that Kristen was able to attend last year, she went to the Tesla AGM, and Nia actually sold Tesla shares from all client portfolios over 3 years ago, but yet we retain enough shares in a non-client portfolio to continue our work and corporate engagement. So if you're interested in seeing a video from Kristen's experience speaking at the Tesla AGM, I'll drop the link in the chat. And other examples of shareholder resolutions we have filed have been on board oversight of human capital management and non-disclosure agreements and employee contracts. But I'll hand it over to Nicole to go into more of the data across our engagement areas.
Hi, thanks, Paloma. Nice to meet you all. I'm Nicole Dodson. I'm in operations and communications at Nia, and support our shareholder engagement work. I'm excited to share more about the data insights that you'll find in the full impact report. And this slide illustrates some of the data points that we're tracking across our SMA portfolio holdings. And when we look at all of our portfolios, these holdings are aligned with a scenario that's 1.28 degrees Celsius cooler than SPGM, with 64% more clean energy exposure and avoiding over 7,400 tons of waste. I want to note that we use SPGM as a comparison because this information is not tracked at an index level, and we use this data to inform our engagements with our portfolio companies. On this slide, we want to focus on some of the corporate accountability and transparency metrics that we track and report on. Nearly all of our portfolio companies have robust environmental, social, and sustainability policies. More importantly, they're making these commitments public. In these times, we continue to monitor this and we'll continue to engage. We also achieve 100% coverage on governance policies, which we understand ensures sound oversight and ethical management throughout our holdings. Finally, this is our impact on community equity and access. We're fossil fuel and fossil fuel adjacent free, given our solutions focused approach that keeps us out of these sectors. We understand that this data showcases our strength with strong diversity and LGBTQ equality ratings. Almost 72% of our holdings have education initiatives, and across all portfolios have 29% of women leaders in the C-suite.
And then at the end of our firm impact report, we touch on the Nia Community Foundation. The foundation was established in 2010 as a 100% mission-aligned impact investment fund. And now the foundation grants to mission-driven organizations that focus on social justice, environmental sustainability, and racial and gender equity programs. So during the time period of our firm impact report, the foundation granted over $200,000 across 56 nonprofits. And since inception through the middle of 2025, over $3 million to nonprofit organizations. And I'll hand it back over to Kristen.
Thanks so much to my team. We are proud of this work and we want to share more of it with you. And so if there's questions or thoughts or how did they do that or why this company or what does it look like behind the scenes to engage with these companies or how is it we're thinking about portfolio selection, we are very happy to engage with you and really proud and excited that you're here today. And then where we're available, this is something that is no small feat to be available at all of these different custodians. And I want to say shout out to our investors because in large part, we become available at each platform based on an investor request. That's basically how it works for asset managers. And so we don't get to just say, hey, we have this one of the lowest carbon portfolios or all of it. We actually run 4 SMAs and they're largely the lowest carbon you can find, often with the most diversity in leadership, with some of the highest activism, and you should just put us on the platform. It doesn't really work that way. And so much gratitude and appreciation to all of the investors who have said, hey, I need to have Nia on this platform. I need to share Nia with my financial advisor. I need to. So that really is, each one of you is having an incredible impact in sharing the word and in and getting us out into the world so that we can increase our impact. It's really a group effort, and we're so appreciative to each one of you, to the team, and then to all of you for putting your money where your mouth is, where your thoughts and your heart is, and where the economy is headed. Thank you so much. And Paul actually asked about that, and I believe as far as benchmarks, and I believe that Nicole did answer that. So when we're comparing what Nia portfolios look like against what? Well, the benchmarks and other indices aren't necessarily collecting the data that we're collecting. And so it can be hard to make some comparisons, though we do look at what is available. And then we also push others to say, hey, this is actually material data when it comes to carbon, when it comes to some of our human capital management metrics. And we do encourage others so that we can have more data and can do more comparisons. Paul, you can help. I'm guessing you're already helping with that effort. And then, and Gary, great question. Why the need to try to save Tesla from itself? So that's a really good question. And it really does stem from a lot of our earlier work, particularly 2019 and 2020, especially 2020, when I was largely sitting at my kitchen table during the pandemic, as many of us were, and I was doing Zooms with a lot of the Tesla employees. Word had gotten out at that time. We were really focused on forced arbitration and how it can cover it's really a concealment clause that can cover some bad practices in companies. And I was hearing from employee after employee about different discrimination cases that they weren't able to bring because of the forced arbitration. And after listening to so many stories, we realized this wasn't a one-off. There was a significant pattern. And so, yes, that's absolutely an investor risk. You don't want to have a large pattern across your employee base where people aren't feeling safe to be able to work and to bring their full selves to work. So as an investor, we saw the risks to get out, and yet the human part of us really are still supporting the employees. And we know that the investor voice can make waves and can make a difference. And in this case, can Tesla be saved from itself? That's a whole nother question. And yet, our work does get media attention, and it does get other investors to start thinking, if they're not already thinking, about the importance of human capital management, about the risks of having racial discrimination, and it can be really empowering. So in those ways, those are intangible ways probably that our impact shows up, and yet we are here seeing that change does happen one conversation at a time. And so remaining in that conversation with Tesla, it feels incremental. It feels small. It feels that that board and that CEO have different ideas of success metrics than many of us do, and yet remaining in the game as far as continuing that strong investor voice feels really important during these times. So thank you for that question. And we can stay in dialogue. Is it a worthy effort? Is it not a worthy effort? I guess that could be discussed and debated, I think, over many different metrics. And yet we do see other investors choosing to say, oh, we could raise our voice too. What else can we do? How can we support? What could we do at this company? Nia, how are you using that voice? And so I think encouraging being part of a strong investor community that is holding companies accountable, I think, is maybe the best answer for that one there.
And there seems to be one more question in the chat. What about your mutual fund, which does not require a third party for investment, by KF?
Oh, absolutely. Okay, well, there is a site for that, and I believe that Paloma can put that in the chat as well. And absolutely, that is a very good point, that you can actually reach that and invest right directly on the site, and you don't have to go to a custodian to do that. So you can do that directly on the site. Really appreciate the call out. We are thrilled to be able to offer a mutual fund that is, our goal really is to democratize access to this type of investing. So to be able to have a low minimum that the mutual fund has and easy access right on the site is definitely part of our mission. We would love to see that out in all of the 401k platforms and options, so that people across the U.S. at any level can be investing for sustainability and for social justice. So thanks for calling that out. It's important. Is there anything else you're seeing that I missed?
No other questions as of now.
Okay. Well, we appreciate your wanting to learn more and helping us spread the word. Thank you so much to everyone for joining today.